Hello, welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. Over the years, many Canadians have shifted their view of a home as not only a place to live and create dreams, but more and more as an ATM to fund their lifestyle or to buy a second, third, and even a fourth property. In fact, never has tapping into home equity line of credits been more popular. Last month, Canadians borrowed $2 billion more in Heloc debt, the largest single month increase since 2012. Joining me to discuss Helocs and mortgage rates are Jason Pereira, financial planner and partner with Woodgate Financial, and Ron Butler, mortgage broker with Butler Mortgage. Gentlemen, great to have you on Strictly Money.
Great to be here.
I know Helocs have been rising in popularity, but $2 billion in a month. Ron, are you surprised, and should it set off alarm bells?
Not really surprised. One thing that consumers think about in the time of enormous run-up in real estate values is, how do I sort of monetize this increase in the value of my house? And in many ways, the HELOC is the best approach. You don't pay if you don't use it, and yet it provides you this potential huge amount of borrowing power. So to your point, there are people who are thinking about buying rental properties, and this form of the HELOC provides the down payment, forms the down payment. And there are people who just think, you know what, maybe someday these house values go down, so I want to lock in my whatever I can available to me to have as borrowing power.
Okay, so what do you think is the reason for the recent rise? Is there anything specific you're seeing?
Yeah, it's a point of the cycle. It's a point of the whole housing cycle that people can't escape the fact that the houses have gone up in price so much. Yeah. I mean, that was so prevalent in December and in January and in February. It was just that everybody was amazed by the growth in house prices. So by the time March rolls around, people stop and think, what do I do with this? What do I do with this huge increase in the value of my house? And HELOC becomes the first thing on their minds, as well. Again, to your point, should I be buying a rental property? Because apparently the prices only go up, at least up until March.
Right. Yeah. Jason, as an advisor, what sort of conversations have you been having about HELOCs with your clients? And the second part of it is, have you noticed a change over the last 5 years?
Yeah, so I'm just going to pick up off where Ron left off. It's Canada, and most people seem to think prices only go up as written in the Constitution. They're sometimes surprised to know that's not there. So basically, what am I seeing? I think at the end of the day, it comes down to, there is nothing wrong with HELOCs. They're just a tool to be used. Yeah. There is no good or evil to them. The question is, what are you using them for? And I tend to deal with an affluent group. So what I used to see them for tends to be very positive versus what I've every now and then come across unfortunate negative uses of them. So are you using a home equity line of credit as a means of basically, for example, providing you with an emergency fund in time of need? Good use. Are you using it to normalize volatile earnings, right? If your earnings swing from quarter to quarter because you're on commission or something like that, and your spending is here, but your monthly income's here, but then your bonus comes up and it's here, and you need to kind of normalize those earnings, that's a positive use. There are some scenarios where borrowing to invest is also positive. But if you're in a position, and this is where the danger comes in, and we've seen this as well, where it is monthly consumption that is making you dip into your HELOC with just an ever deepening pot of money being owed, or your mortgage and your HELOC end up basically keeping you at the same level of debt, you have a fundamental spending issue. And unfortunately, I think we've seen a lot of Canadian consumers with that. And I think the trend is getting worse, at least more recently, because we're starting to see the stories creep up because of people having difficulty maintaining their payments on their variable rate mortgages and HELOCs, which are now climbing up. Now, this is very early innings. We don't have a lot of data supporting this, but it is disconcerting, and more people are becoming alarmed by it.
Yeah, because I don't think a lot of people, one, thought that interest rates would go up the way they are. And then on top of that, you have inflationary pressures. We only have about 30 seconds left. My question, I guess, is, in your experience, do you think people even understand what they're getting themselves into?
I think that there's a cohort of people who view equity in their home as something that's not being used and needs to get out as fast as possible. There's definitely a cohort that the second they have enough room there to basically take it out and buy another property or do something else with it, it's gone. And what I think the danger is with that group is, especially that group, given the fact we haven't had a major correction in decades now, is they have the attitude of it only goes up.
Welcome back. Ron, something you tweeted recently caught my attention, and that was how you're getting 10 calls a day by someone who bought a rental property and now needs to refinance their house for repayment. What are you saying to them?
Yeah, that's refinance a house for down payment. So they've gone out and found themselves a condo, townhouse that they've decided fits their plans as rental property, gone ahead and put a small deposit on it, and now they bought it. Now they need to get a larger down payment out to complete the 20% of the property value to then get a mortgage on the remaining 80%. And yeah, a lot of those calls, people know they have equity in their homes, but they've bought the rental before they've executed on the transaction of having the HELOC available. So you start to scramble to make sure you can actually accommodate what they're wanting to try to do.
Okay. With house prices sort of coming off, Ron, I mean, we are seeing that. Where do you see prices trending in the near term?
Down, just down.
Definitely, yeah.
Yeah, that's it. I mean, you can't escape from math. So at this moment in time, we're looking at rates in the 5-year fixed and soon in the variable once this full cycle of prime rate increases comes from the Bank of Canada. We're looking at clean doubles in mortgage rates over 12 months ago. That's a big change.
Yeah.
Double is double. You can't, no matter how you want to talk about, they were higher in the 80s and they were higher in the 90s. And no, you can't talk about that. You can just talk about what's been going on for the last number of years. And over 12 months, we're looking at a pure double in mortgage rates.
So what kind of impact, Jason, I'll ask you this, what kind of impact could this have on Helocs? And I guess the other part is, can banks or financial institutions actually just call something in? What would trigger that?
Well, Ron knows about this better than I do, but
Yeah.
the answer is yes. These are callable loans. And what could trigger that is whatever whim they please, right? These are not exactly, you have to hit these 5 check boxes before we call it in. And correct me if I'm wrong, but it's basically to their discretion. Now, what's kind of impact is this going to have? To reiterate what Ron said, doesn't really matter that interest rates were higher in the 80s. Look at the levels of debt we have now. The 20% interest rates and the smaller bases of mortgages, the mortgage debt, that led to a number that was people can manage. Now we're dealing with average prices north of $1 million, and a lot of people having $700,000, $800,000, $900,000 mortgages. A 1% change on a $900,000 mortgage is $9,000 a year, right? That is a sizable chunk of change. And it's not like discretionary income is increasing at any real substantial rate in Canada. It's not like there's actually a lot of discretionary income beyond that. So the reality is that Ron's statement is bang on. You can't avoid the math. The math don't lie. We have not seen, we're seeing inflation everywhere. We're seeing increasing cost of borrowing, which is basically going to drive the cost up on HELOCs, on your mortgage if it's variable. And we're seeing stagnant earnings. So something's got to give somewhere.
Yeah.
And it's going to be, and if it's consumption, that impacts the economy. If it's your mortgage, then you got a bigger problem. We
got a big problem because our economy is 10, 12%, it's tied to housing. Ron, your thoughts on this? So what would trigger a bank to say, I'm calling this in, or a financial institution to call this in?
The most important thing to say is it almost never happens.
Okay.
It's an incredibly rare event. It's almost doesn't exist. The calling of the HELOC, you need to pay us all this $160,000 back next Tuesday. Doesn't happen. What does happen and can happen, and in all likelihood will happen for a few people, is the bank will say, you have no more limit. You have a $200,000 HELOC, you used 150 of it. We're taking away the 50 that was remaining. You're going to have no more limit. And you're going to start to make fixed payments on this HELOC. and every time, and your HELOC will no longer increase every time you make a payment. The approach will be, you need to pay this HELOC down in an orderly fashion and not access any more of the credit.
So would you advise someone to start preparing for that? Like what would someone have to look at in their home to say, you know what, this could happen, I need to prepare?
They would have to miss payments. They would have to miss their minimum payments. They would have to miss a mortgage payment, because most people with HELOCs also have a term mortgage that they're making amortizing payments on. They would have to miss a payment. Miss a payment in the mortgage business, miss a couple payments, lots of things happen.
Right.
Lots of things.
Okay, we're going to take another quick break, and we'll be right back to continue this conversation. Welcome back. We know that the Bank of Canada has taken an aggressive stance against inflation. You know, rates are up 75 basis points, likely another 50 basis points when they meet June 1st, and probably a little bit more. Ron, can you talk about the impact that this is going to have, maybe in terms of numbers on HELOCs, those who have HELOCs, and maybe even variable mortgage rates? It's kind of, I mean, HELOCs are based on variable rates anyway.
Yeah, HELOCs are based totally on prime rate. So every time the Bank of Canada raises prime rate, your payment on your HELOC goes up. It's that simple. Now, by the time we're finished, all the increases that we could anticipate this year, again, there is an excellent chance that HELOCs will be a clean double in rate. You will be paying twice as much by the end of the year as when you started this year. That's a very high possibility. As far as variable rates are concerned, many banks offer a variable rate product where your payment does not change, even though the prime rate goes up. Now, this is a bit mysterious to some people, but it should be better understood. What it means is you're paying less off your mortgage. The rate still goes up, the interest still increases. So the principal does not get paid down as fast. Therefore, some people at the end of 5 years will discover that they thought their mortgage went from a 25-year amortization to 20 years, and they will find out it went from 25 years to 24 years and 3 months. So there will be some surprises down the road.
Okay. Jason, you touched on when HELOCs do make sense, right? We know, like, emergency funds, for example. What about using HELOCs for investing? Because I have to think that that would have been pretty enticing maybe a year ago when we saw this massive market run up, maybe not so much now. But what sort of advice would you have for someone who does that? And it's really about taking advantage of the interest rate differential, right?
Sure. Well, I would say that it very nominally, when people look at how much what they think they can make versus how much they're paying, keep in mind, one of those numbers is variable for sure, the return number. The other number, if you can fix it at a very low rate, then that's what you should be doing. To leave it variable creates another kind of variable in the equation that can go wrong for you. Mm-hmm. So when does it make sense? It makes sense when you can secure low amounts of low cost debt relative to a higher investment. Now, keep in mind here's the problem. This not only basically allows you to invest more money, it magnifies returns as well as losses, because at the end of the day, that debt is still owing. So if you're someone who basically decided to take out a bunch of money out of a HELOC in, let's say, January, and invested in the market and went 100% equity, specifically in technology, right now what you're doing is you're licking your wounds. Your rate has gone up, you're down 20%, and you're basically going to, if you want to get out of this, you have to swallow the loss. Right. So the reality is that if you're going to do something like this, it has to be done first off with as much protection and sound wisdom as possible. A, do you even need it, right? In most cases, I have not seen financial plans where leverage was the conclusion or the only way they're going to succeed. Mm-hmm. B, if you do it, how much security can you create around it? And lastly, C, how much risk are you truly exposing yourself to? And do you have the timeline to absorb the volatility? So this is not a conversation people should take lightly, but unfortunately, many people do race into it. Yeah.
And, Jason, like, for the longest time, there's been this belief that your home is your ticket to a sound environment or retirement, right? Everyone's banking on this. How do you both feel about that now?
Well, there are things like reverse mortgages that allow people to access the equity in their homes when they're of a retirement age. and there's no payment on those reverse mortgages. You just sit in your home and the interest compounds. Unfortunately, in the last 8 months, those interest rates have also doubled. So the compounding effect becomes larger. At the end of the day, it's a financial tool. It's not for everyone. The reverse mortgage, not for everyone, but it does work for some. Now, there's the compounding issue that we're going to be faced with in the coming months, that the value of your home is going down. I mean, that's going to be reality for most people in Southwestern Ontario. So the availability of how much of a reverse mortgage you can get is also going to be subject to being smaller. You won't be able to get as much.
Yeah. Jason, can you explain? We see these commercials all the time, and we only have about 30 seconds, but we'll pick this up again. Chip reverse mortgages, how do they work? Why are they different from
So,
Helocs?
as Ron said, you're borrowing money, but you're not making payments. Essentially, the interest compounds against the loan outstanding and continues to increase over time. So I would say these are the most hated, wonderful product for retirement. People don't like the idea, but in some cases, look, if you want to stay in your own house, you can't eat the bricks. And if you're out of money, you got no choice. However, the danger is you take it out at 70, you're asking for trouble. You take it out at 90, you're pretty secure, because it's all about how long the period of compounding is going to be.
Welcome back. Jason, we were talking about reverse mortgages before the break, and you were explaining what people have to be aware of. Yeah, please continue your conversation. I mean, are people understanding in retirement the implications of having these?
I think those who do not want to modify their lifestyle early on and they don't have enough retirement savings rush into them way too fast, because they don't want to deal with the reality sometimes. So they need the money. They don't want to downsize the house. They look at all the equity and they take it out. And if they're, like I said, if you're in your 70s, that's a long time for the interest to compound against the debt. And I've been in situations where clients did this when they were in their early 70s and now they're in their 90s and they need to go to a nursing home. And guess what? The amount of equity left in the home is next to nothing. So the reality is that, yes, you'll get a loan for typically up to 50% of the total amount that the thing is worth at the time. But the remaining 50% is not guaranteed to be there in the future. It depends on interest rates versus the growth of the house. Now, again, like I said, later on in life, it's, they don't have much time to compound. So there's going to be that portion left at some point. But when it comes to people wanting to stay in their home and not downsize or do any of that, or maybe they don't have the option and they've run out of other income streams, really it's the only option.
I know, and that's the tough thing, right? Because I'm talking to a lot of people who are like, well, I'm dying in this home. And so they think, well, somebody else will deal with it. I mean, I'll be gone and whatever's left is left. Yeah. Here's a philosophical question, I guess, to both of you. What do you think we need to do to protect home buyers, in some cases from themselves? Ron?
Well, the rise in interest rates is going to be a factor in protecting them from themselves, because the stress test is a layer of additional estimated interest on top of already rising interest. So a great many people are just not going to be able to afford to get a mortgage that's going to suit the existing prices of houses. But eventually the prices of houses will come down, maybe significantly. And that will actually create an opportunity for first-time home buyers to get a much lower price.
Do you still recommend, or do you recommend going fixed right now, or variable for those who are looking?
We're thinking about short-term fixed. We believe that this rapid run-up in fixed rates, particularly in the 5-year, will eventually crest, maybe a year from now, 2 years from now. And the likelihood of a recession in future is fairly large at this stage. That forces prime rate to come down. That forces the bond yields that control fixed rates to come down. And we may see some rate relief at the end of 24 months. So short-term fixed rates are a solution in that regard. The trouble with long-term 5-year fixed rates is, if the rates indeed do go down in year 3, the penalty to get out of the 5-year fixed is so large, it's not mathematically sensible to try to get the better rate. So today, short-term fixed might be the answer.
Okay. Jason, what do you think we need to do to protect home home buyers, home owners? I mean, you look at this in a very holistic view as a financial planner.
Yeah. Short of a time machine to fix a bunch of public policy mistakes over the last couple of decades. Here's the thing, they're inundated by their peers and their parents about how real estate was the best thing that ever happened. A lot of these people are basically feeling like they got left out, and they're breaking their necks to get into houses, thinking it's the ticket to double-digit returns. Like, I cannot tell you how many times I've had to dispel this myth that this is normal and just break it down with basic math. So, frankly, I think there needs to be a very sober conversation amongst the media, amongst everyone involved, is to say, this is not normal. This is not sustainable. And frankly, the most important rule in financial planning is do not put yourself in a bad position. You put yourself in a bad position, maybe it works out, but if it doesn't, you're going to make some very, very hard lifestyle decisions later on you're not going to be happy with. So frankly, what needs to be done to protect them? They need to accept reality. And we need to be more open about this, and more sources, not just trumpeting how wonderful every month's return has been for the last several years. And a time machine.
Yeah, I mean, I have this conversation all the time with people, and they're like, well, it's gone up for the last, 10 years, and we keep missing out on it. So, there's more upside, but there's so many other variables, right? There's the employment picture, and obviously interest rates, which have been at least a decade low. Gentlemen, thank you so much for coming on today. Really appreciate it.
Thanks for having us.
Ron Butler and Jason Pereira. Well, that does it for this show. If you have questions about Helocs, or you're concerned about the impact of rising rates on housing, drop us an email. We'd love to hear your feedback. Thanks for watching. Until next time, stay well, stay wise, and stay well.